The US dollar continues to press higher. That's been the story so far for the past 2 weeks. But not everything is created equal. When we look at currency markets, of course, we are always valuing one currency against another. And the dollar's robust surge over the past 2 weeks has not been faced equally by its major counterparts. And that seems to create a trading opportunity. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we are going to focus our energies for a second day in a row now on the currency markets, where we might be looking at an opportunity here for a bit of a reshuffling in how these currencies are performing amid the US dollar upswing. So let's consider here first the upswing itself. It's happened really over the past 2 weeks for the most part. One might argue the dollar hit its recent lows around the 24th or the 26th of September, but the rally really starts September 30th. So that's the starting point that I've taken here. These numbers shuffle around a little bit if you choose an earlier one, but the difference is really only about 4 or 6 days, and so the differences are nominal, and there's no difference in the direction of these moves. So what we've done here is benchmarked from the day the dollar has its first real move off the range bottom that got carved out in September. We can see that over that time, the dollar is up 2.5% almost against an average of major currencies. The 4 currencies, incidentally, that you see here: euro, pound, Australian dollar, and yen. These are the 4 most liquid, not US dollar currencies, according to the data that's compiled by the Bank of International Settlements. And they give a more telling average of how the dollar is doing versus, let's say, the DXY, the US dollar index, which is something that was constructed before there was a euro. And so it was constructed as a dispersed basket at the time, but of course, much of that basket has since become the euro, like the Deutschmark or the French franc or the Italian lira, say. And so DXY is now something that is not exactly the most telling of things, because it is mostly just euro and a sprinkling of other things, some of which don't really speak to where economic activity has moved over the decades, mainly Asia. And so there isn't really a reflection of Asia, and in particular China, there, other than the yen, missing the Aussie, which is, because of that shift, now a top 4 non-USD currency. So all of this is to show that over the course of this rise of nearly 2.5% in 2 weeks for the dollar, which incidentally, if we just put that in perspective a bit, is the largest 2-week rise since February of 2023. So this is a significant change, of course, here. We have a difference, clearly, in how some of these currencies perform against the dollar. All of them are down, but clearly to differing degrees, and some differentiation clearly comes regionally, and other aspects of this differentiation come down to relative rates. Now, we can see here, Europe has clearly held up better. Euro and pound are down only 1.6% apiece. The Aussie is down 2.6%. The yen down 3.7 almost. For the yen, this makes sense. For the Aussie, this makes sense. Those currencies have not seen any major difference in their monetary policy outlooks. Much of what's happened there has been driven by the sharp rise in US interest rates, in particular at the long end, following the Fed's meeting mid-month. We of course saw that what the Fed did was cut rates by 50 basis points, and what that saw was a dramatic rise in interest rates at the long end. So ZB, the long bond, has fallen precipitously over the past couple of weeks. ZN, the 10-year note, has fallen precipitously. Why have yields risen at the long end? Well, as we've talked about quite a bit on the show here, expectations of reflation have followed the Fed's move. U.S. economic data has performed increasingly well relative to expectations. That has put the current stimulative turn from the Fed in the context of an economy that seems to be heating up, and has signaled to markets that we are going to have less scope for rate cuts downwind, that essentially we're cutting now, but there's less room to cut, and there's less scope for the rate cut cycle to continue over time. And that what this is a reflection of is the reflationary dynamics of stimulating an already healthily growing economy. And in response, we've seen long end rates have increased, the yield curve has steepened, gold has gone up, the measures of inflation expectations in the bond market, break-even rates, they've gone up. They're at this point at the highest we've seen them since June. So there's been this significant reimagining of what the U.S. rates structure looks like following the Fed's meeting. That shift has unmistakably hurt those currencies where there wasn't really a shift, and so holding one set constant and moving the dollar to a better yield footing has clearly weighed heavily. Now, in the case of Japan, they of course have lower rates than any of the bunch. Not surprisingly, the pain was most acute for them. The Aussie has come next, and the weakness we've seen most recently in China hasn't helped. But in Europe, the more moderate losses have largely come as expectations for easing from those central banks, which have already been cutting and in fact started before the Fed. Those expectations have come in a bit. And we begin this conversation this week. We're going to continue it over the course of 2 days here. This is day one. We begin it in the UK, where if we look at the current path of policy expectations, we can see the outlook as it is baked into benchmark futures has held relatively steady for 20 to 24, right here. So that's 35 basis points in easing still left. And what that amounts to then, notice this has been fairly steady since we saw this readjustment, this cut earlier. The implication here is that we have at least one 25 basis point cut that's on the menu for the remaining two meetings, the one in November and the next in December, and that there is then about a 70% chance that it'll be 50 basis points. So we've baked in 35 out of 50 basis points that would be two cuts. So there's about a 70% chance here that you are tilting cumulatively in the direction of two cuts. So the important thing here, stasis. This hasn't changed a lot. But what we can see is that over here, the outlook for next year has come in a bit. Now, more recently, there's been a bit of wiggling into a more dovish direction. We're at 90 basis points now for next year. But having said that, it is obviously very different from this over here, which is closer to something like 1.6%, 1.5% in cuts right here. So with that in mind, it makes sense why the pound might be a little bit more resilient. We can even see this in the way that we've readjusted in the implied rates curve. So this right here in the solid line is the current curve. And we can see here's the current bank rate, 5%. For November, we can see we're almost down to 4.75, not quite there. And so it is almost like we have baked in a full rate cut. We're 19 basis points into a 25 basis point cut. So there's a 76% chance implied here that November gets a cut. Notice that by December, we're already into that cut. So 465 gives us a level that's obviously below 4.75. And what that is telling us is that we are already into at least one cut. Now, if we then see from there, then there's about 15 basis points into a second cut that are there, which then gives us a further 60% chance that we are going to get a cut in December. So cumulatively here, we're tilting in the direction of two cuts. This would be at 4.5 if the cut were already there. And by the way, notice by February, those two cuts are already there. And then by May, 50 basis points more, almost. By the end of 12 months from now or so, a further 25 basis points is in the consideration. Notice that we are at this stage also a little bit less dovish than we were the last time that the Bank of England met in mid-September, incidentally, the day after the Fed. Here's where that curve was. Here's where the current curve is, and it is basically in line with where we were on expectations back in August. So this little shift right here helps to explain this adjustment here. A little bit less dovish, if only mildly so. And that might explain then why here the pound does much better than the Aussie or the yen, where that kind of a wiggle hasn't happened. But is this resilience going to last? Well, this week might give us that answer, and that answer might be no. Here's why. Here's the UK CPI report that we're expecting to see here over the next 24 hours. It is expected to give us UK inflation at the headline at 1.9%. That's, of course, into the central bank's 2% objective. Now, 1 month does not make or break the central bank's calculus. It is looking for inflation to be at a certain level over the medium term. So 1.9% over a single month is not anything to declare victory over per se. Nevertheless, at 1.9%, this is a very encouraging sign, in at least so much as this is the lowest since April 2021. So very encouraging. At the core, we're seeing ticking a bit lower, down to 3.5%. Now, if we look at the makeup of this inflation, so since the UK targets this headline, we can take a look at the main components here, especially since we see housing and housing, fuels, and utility costs here being a major source of disinflation. The main components still are recreation and hospitality, restaurants and hotels. And this has been the story now for 5 months straight, that these two sectors have been where most inflation is still sticky. Here's the downside we see on household goods. Here's the one on fuels and such. And you can see here, this is furniture, this is fuels and maintenance. We can see both of these are where things have actually turned deflationary. Everything else here looks fairly modest. These two accounting for 1.1, almost 1.2 percentage points of the latest CPI numbers that we've already seen from August. That's where things are sticky. Now, because these are what they are, they're relatively sensitive to discretionary spending. Recreation, hospitality, then are very sensitive to people basically saying, well, I'm not going to spend on things that are optional, as it were. And that, of course, comes down to the economic cycle. If there is a downturn in the economy, then discretionary spending is, of course, first to suffer. And if we look at the way UK economic data has performed recently, we find that it has increasingly deteriorated relative to forecasts, such that at this stage, this index, this is from Citigroup, it is now below zero. Here's that zero line. When it is below zero, what that suggests is that the data is tending to underperform. It's tending to miss, that is, relative to median forecasts, and essentially implies that the models that economists have concocted to spit out forecasts for incoming economic numbers, those models are tuned more optimistically than reality has actually endorsed in practice, at least over the recent weeks. And so what you've now seen is a significant deterioration. This is pointedly on display in the latest PMI numbers, where we can see here a downturn and an unexpected one. So here, manufacturing slower. The fact that it's growing is, of course, a feat of note, considering it isn't growing in the US or in Europe or in China. In the UK, it's actually growing. But the most recent September numbers give us slower growth all around on services, on manufacturing, and of course, overall. And all of these numbers, save for manufacturing, both services and the overall number missed relative to expectations when they came out and were then revised down further. So we're looking at a situation here where it appears like things are deteriorating, and key measures of growth are seeming to fall within those dynamics. That suggests then that whatever we're seeing here from the inflation side of the story becomes amenable to downside surprise risk. First of all, the numbers themselves might fall within a pattern of deteriorating data outcomes relative to forecasts. But of course, secondly, that there is economic slowdown that is accounting for some sort of a deceleration here, perhaps as that slowdown starts to eat into these discretionary spending categories, you have something that gives the Bank of England a signal for follow-through. Because, of course, economies don't rapidly turn up and down as speedboats. They are more barge-like in their behavior. They turn slowly and over a long period of time. So, hence, by the way, why central banks target medium-term inflation and not inflation tomorrow or next quarter. So, as we look at this then, we get a story of perhaps this surprises on the downside, and perhaps that is a durable narrative that the Bank of England can take and say, well, actually, it looks like inflation is going to get to where we need to go, and we have greater confidence in that based on these numbers, because there's follow-through there. And on that basis, maybe the view for policy is more dovish than what this looks like. Maybe this recent readjustment doesn't make sense. And what we really need to do is up this number here and go from only 35 basis points being baked in. Maybe we need to make it official and move down to something closer to 50 and say these two cuts over November and December aren't just likely, they're all but fully baked in. And while that's a relatively modest adjustment, it wouldn't be that far to go here to make that adjustment, a mere 15 basis points. It could have a significant impact on the British pound. And that's where the trading component here comes in. Here's the British pound relative to the US dollar. These are benchmark 6B futures. And here's that decline in the pound as the outlook for the dollar has shifted, right? Here's that move here. And that has taken us basically right to this support level in the 130 to 130.50 area. So this former high, this recent swing bottom, this seems to be the place where we are holding at the moment. We can see from the structure of these candlesticks that we're sort of skidding into it. The candle bodies are getting smaller. We're kind of idling right here. If we get soft CPI data that takes us through this level here, a test under 129 seems like the next logical inflection zone. And if we crack that, well, then you open the way up to test under 127. But because you're on this key support here, even a minor change because of a weak CPI number in how much certainty there is around what the Bank of England might do over the next two policy meetings could take you through here. And that would be significant confirmation, perhaps, to start to have momentum onto itself. People would notice that the price has held 130 since early September and then hasn't been able to do it again. And that might start to inspire speculative selling, in which case, at the very least, then you get a move down to test under 129 in relatively short order. So even a minor change here could give you a key breakdown and a tradable opportunity. Now, of course, we don't know that that's going to happen, and until the price action responds, the risk reward to selling is relatively unappealing because, of course, we are sitting on support. But if the data lines up such that it is weaker and the response then is what might make sense in that scenario, a selling opportunity might then emerge. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I'm on with Victor Jones on Wednesdays for the Price of Truth, on with Chris for Futures Power Hour on Fridays, writing for the News and Insights portion of tastylive.com. and commenting on the platform formerly known as Twitter at Ilya Spivak. If you're watching this on YouTube, like and subscribe. Macro Money will be back tomorrow. Happy trading.